In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about why ICICI Prudential AMC's IPO reveals so much about the future of mutual funds in India. And in the second story of the day, I'll talk about how India has quietly built the world's most open and powerful digital payment system and why that openness might now suddenly be under threat. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 15th of July. See, ICICI Prudential AMC, which is one of India's largest mutual fund companies, is preparing to go public. They've recently filed the paperwork to go IPO. Now, we don't really know the price of these shares yet, or even when the IPO will exactly open for that matter. But what we do know is that this is going to be a full offer for sale. That basically means that none of the money that is raised from this IPO will actually go to the company itself. Instead, it will actually go to the existing shareholders who are looking to exit their stake. But again, while that detail tells you how the money flows, what is far more interesting here is what this IPO tells us about the mutual fund business in India today. See, when a company files for its draft red herring prospectus, or DRHP as it is commonly referred to, it has to disclose all kinds of numbers about its business. These include things like how it earns money, what it spends its money on, how much profit it makes, and what are the risks that it faces. In some sense, you can think about it like the CT scan of an entire company. And in this case, it also acts as a mirror to the larger mutual fund industry, which is quietly going through a very big transformation lately. See, 15 years ago, mutual funds were not something that most Indians even bothered about. The average Indian's investment decisions were guided by somebody in the neighborhood who sold insurance to them, mostly from LIC. Products like ULIPs, which mixed insurance with a bit of stock market exposure, were seen as a smarter way to save money. Investing directly in equity was basically considered risky, maybe even reckless to some people. But again, a lot has changed since that time. The rise of mutual funds in India has come from a combination of multiple things. First is regulators like SEBI pushing for more transparency. Second is a growing middle class wanting better returns than fixed deposits. And third is a lot of advertising that reminds us that mutual funds sahi hai. Fintech platforms, including our own at Zerodha, have also played a very big role in making investment easier, friendlier, and also more accessible. But again, for all the progress that has been made, mutual fund penetration in India is still very, very low. Out of 70 crore PAN holders in our country, just about 5 crore people invest in mutual funds. And mind you, that number is based on folios, not even unique individuals. The real number of people is actually closer to 3.8 crore, or just about 5% of the total population of PAN. So that means that for every Indian who has invested in a mutual fund, there are about 19 others who have not. It's in this environment that ICICI Prudential AMC has chosen to list on the stock market. And to understand why this move exactly is so interesting as I'm making it sound, we need to first understand how the mutual fund business works in the first place. See, at its very core, the AMC business, which by the way stands for Asset Management Company, is fairly very simple. The company collects money from individual investors, it pools it together, and then invests that money on their behalf. And in return, of course, it charges a small fee every single time. The total amount of money that the company manages is called its AUM, or Assets Under Management. And this is where everything begins. See, as of the March quarter in FY 2025, ICICI Prudential AMC was managing about 61.3 lakh crore rupees across its mutual fund schemes. But it's not just the size of the AUM that matters here. What really determines how much money an AMC can make is the kind of mutual fund that it is managing. And that's because different types of funds come with different expense ratios, which by the way is just another way of saying that they earn different levels of fees from different situations. To give you an example, equity mutual funds which invest in stocks usually have a higher expense ratio. So if you invest in an equity mutual fund through a distributor, the AMC may earn around 1.5 to 2% of the total amount that you have invested every single year. But if you go for a direct plan which skips the distributor, basically the expense ratio is lower, maybe at around half to 1%. But again, it is still a fair amount of money. On the other hand, debt funds which invest in bonds and fixed income earn far lesser amount of money, usually at just 0.25 to 0.75%. And if we talk about passive funds like index funds or ETFs, they make up even lesser, which is just 5 to 20 basis points, which is 0.05% to 0.2%. So even if two AMCs are managing the same amount of total money, the thing is that their revenues can be very, very different from each other depending on what kind of funds they focus on. And this is exactly where ICICI Prudential AMC stands out more than the others. See, more than half of its AUM, which is about 55% to be precise, is in equity schemes itself. Now that of course is good news from a business point of view, because equity funds, like I said, earn higher amount of fees. And what's even better from this perspective is that more than 80% of the equity money is actually actively managed schemes which charge higher fees than passive ones. So in short, ICICI Prudential AMC has a more profitable mix than many of its other competitors. Now, if you compare it to its peers, it is a leader in actively managed funds with about a 13.3% market share in this segment as of March 2025, according to CRISIL. They also earn a larger share of its AUM from retail investors, and that matters because retail investors tend to stay invested for longer on an average, and they are slightly less fee sensitive than big institutions who have a bigger stake in the game here. But that said, it is still not the biggest AMC in India overall. SBI Mutual Fund manages more total assets, but again, that's largely because of the massive inflows it gets from government organizations and PSUs, which usually pay very low fees. And if you talk about HDFC here, their AMC is more profitable despite being relatively smaller, thanks to an even heavier tilt towards high fee equity funds and tighter cost control overall. But ICICI Prudential AMC also has an edge in the kind of customers that it is attracting right now. It has been particularly successful in bringing in investors from outside the top 30 Indian cities, which is what the industry calls B30, which is basically short for beyond top 30 cities. Now, these markets are still under-penetrated relatively when it comes to mutual funds, so there is a lot of room for them to grow. They also tend to prefer regular plans over passive products, which again helps margins for ICICI and any other player for that matter. So all of this overall has helped ICICI Prudential AMC grow pretty rapidly. To give you a sense, in FY 2025, they earned close to 5,000 crore rupees in revenue from operations. And even out of that, about 2,650 crore rupees came in as net profit, which gives them a net margin of around 50%. And that, let me tell you, is exceptionally high for any financial service business. Banks, for instance, have a very high revenue, but they also deal with bad loans and keep aside a lot of money as capital. Insurance companies have to manage long-term liabilities and also deal with delayed profitability. But AMCs, in contrast, have very few overheads once they hit a certain scale. They don't really need working capital, they don't need large office networks, and once they build a team and infrastructure, the cost of managing the next rupee is very, very minimal. And that is why they can become such strong cash-generating machines over a long period of time. And ICICI Prudential AMC's revenue growth also tells exactly this story itself. In FY 2023, they made about 2,837 crore rupees. In FY 2024, that went up to 3,758 crore rupees. And like I said, in FY 2025, it almost hit 5,000 crore rupees. That, of course, is a massive leap in just 2 years. And the reason here is twofold. First, the amount of money they manage is growing. And second, the kind of money they manage is becoming more and more profitable as time passes by. They also have other businesses, by the way, like PMS or portfolio management services, and AIFs, which are also alternative investment funds which cater to high net worth and institutional clients. But again, these contribute a very tiny slice to the revenue, which, to give you a sense, is only 49 crore rupees in FY 2025. Most of the money still comes from mutual funds. But anyway, moving on the cost side, a large chunk of the money actually goes towards salaries, which, if you think about it, makes sense because this business largely runs on smart fund managers. Another big spend is on distribution, especially in regular plans where they need to incentivize banks, agents, and platforms. But that said, with more and more people now shifting towards direct plans and digital onboarding, they are also having to spend heavily on technology. But even with all of these costs, the margins remain incredibly strong. But that again said, it's not all smooth sailing. One very big risk here is regulation. The mutual fund industry has changed dramatically over the last 15 years, which is mostly because of SEBI. In 2009, SEBI banned entry loads, which is the practice of charging upfront commissions to investors. In 2013, they introduced direct plans, which basically bypass distributors and lower the cost for investors. And in 2018 and 2019, they put caps on expense ratios, so AMCs could not keep charging whatever amount of money they wanted. And more recently, they even suggested that fund houses should only be allowed to charge higher fees if they consistently beat the market. So all of this is of course great for investors, but from purely a business point of view, it is a very big challenge. AMCs do not have full control over their margins, and SEBI can change their rules at any point in time. And those changes can also directly impact profitability very, very heavily. Now that said, there's another major shift happening here as well, which is the rise of passive investing. See, more and more investors are now putting their money into index index funds and ETFs, which by the way are funds that simply mirror the market rather than trying to beat it. Now these passive funds have grown to 10 lakh crore rupees in assets, or about 20% of the total mutual fund industry. And last year, more than half of the new investments went into passive products itself. Now of course, again, this is great news for investors because it involves lower fees, no dependence on a fund manager's performance, and simple to understand as well. But again, it's not great for AMCs like ICICI Prudential, who rely heavily on high margin active funds for most of their earnings. So going forward, if more investors move towards passive, the revenue per rupee managed will start to fall. And that of course will put pressure on business models that were built on active investing. So to stay competitive, ICICI Prudential will likely have to expand its passive offerings, even if that hits their margins. It's a classic trade-off, which is that staying relevant requires them to take a hit on their fees. But anyway, moving on, there are some more risks that are worth mentioning over here. See, this business is very heavily tied to the market. When the stock market is doing well, people tend to invest more, fund NAVs go up, and AMCs earn a lot more money. But again, when markets fall, things get very difficult overall. AUM shrinks, investor confidence drops, and redemptions start to increase all of a sudden. But meanwhile, the AMC's fixed cost obviously do not change, so profits end up taking a hit. There is also the issue of talent here. A few top performing fund managers can make a huge difference to the performance, the inflows, and investor trust of a fund. But they're also high in demand for obvious reasons, and if they leave for any reason, it can very heavily impact the company's reputation and also flows. So in many ways, ICICI Prudential AMC's IPO is not just a financial event. This is pretty much like a moment for us to reflect on how far India's mutual fund industry has come and where it could be headed next. The company itself looks like a very strong cash generating machine today. It has a strong active equity mix, has a growing scale, high profitability, and has a digital savvy distribution. But again, the world around it is changing very, very quickly. Regulations, like I said, are tightening, passive funds are gaining ground, and retail investors are becoming more fee sensitive and also better informed. So therefore, the next decade over here might look very, very different from the one that got us so far. So if you are looking at this IPO as an investor, the question to ask is not just how much money ICICI Prudential AMC is making today, but how well it will adapt to the changes that are already going on right now. Because in this very business, scale could bring rewards, but staying relevant could bring survival. And that's probably more important than anything else. On that note, let's move on to the second story of the day. See, most of the time when we talk about the Indian economy on this show, the focus tends to be on what's broken. It could be red tape, poor infrastructure, unpredictable rules, or for that matter, how difficult it is to get things done in general. But every now and then, you also come across a sector where India did not just catch up with the world, but actually went ahead of it and did very well. One of those rare and remarkable examples is UPI, which is the Unified Payments Interface, which I'm sure all of us have used at this point. A recent paper by the International Monetary Fund, or the IMF, looked into how UPI became so successful, and what they found is extremely fascinating, which I think is worth sharing with all of y'all. Now, I know to a lot of us, it might look like digital payments are easy to build, because after all, most people today have a smartphone and a bank account. So how hard could it even be to put a simple payment system in place? But that's exactly where most of the countries actually get stuck. They don't really have anything close to what UPI has become in India. So the question then is, what makes UPI so different, and why did it work so well in our country? That's what this story is really about. So to fully understand it, we'll need to rewind a little bit. See, before UPI came into the story, India already had a few digital payment systems, but most of them were not great for obvious reasons. NEFT and RTGS, for example, allowed money to move between bank accounts, but the thing is, they only allowed it during specific hours in the day. And they were not instant either. You'd often have to wait a few hours for your money to reflect in the other person's account. And that is not ideal, of course. So to solve for exactly that, in 2010, India introduced the IMPS, or the Immediate Payment Service. It was obviously a game changer in its own right, because IMPS allowed real-time transfers between bank accounts at any time of the day, including on holidays. And that very quickly made it the backbone for instant digital payments in our country. But again, IMPS had its own set of challenges. It relied on clunky interfaces, which means you had to enter long account numbers, IFSC codes, and you also had to hope that you did not make a mistake in this entire process. It worked, of course, but it was not exactly user-friendly, so to speak. So that is where UPI came in. It was built on top of the IMPS rails, but it made the experience far more smoother. UPI basically took away all the friction. So instead of now typing out long account details, you could just use something very simple like a virtual ID, which could be in the format of your name and bank name, and you could send money in just a few taps. Now, more importantly, it allowed anyone, and not just banks, to build an app that could just plug into the system. You did not need to use your bank's official app anymore. You could use whichever UPI app you liked. And that small thing alone changed a lot of things. But even that honestly was not enough. For UPI to really take off in our country, we needed to solve a few deep-rooted problems first. A big one was financial inclusion to begin with. See, for a digital payments to work, obviously, people first need to have bank accounts. That's where the Jan Dhan Yojana helped. It opened up millions of new accounts across our country. But again, opening bank accounts was not enough either. You also needed a way to make sure people were who they said they were, because otherwise fraud would be very, very rampant. And that problem was solved with Aadhaar, which allowed for easy identity verification. But even with all of these facilities, if mobile data was expensive to begin with, people would not want to use digital apps to make small payments that they do every single day. So this last piece of puzzle was solved when Jio entered the telecom market and made data dirt cheap for everyone. So by 2016, the basic ingredients, so to speak, were in place. Bank accounts, Aadhaar, mobile internet, etc. All that remained was a push to get people to start using the system now. And that very push came through a sudden and massive shock, which, like we all know, is demonetization. Practically overnight, most of the cash in circulation became invalid. ATMs had long queues, we might remember, and people needed an alternative, and that too quickly. Now, UPI was not the only option available. Wallet apps like Paytm also saw a very big spike in usage, but the real difference came a few months later. See, once cash returned to the economy, most people stopped using wallets. UPI, though, kept growing. In fact, usage tripled very soon after, and that was the first big sign that this was not just a one-time experiment. People actually started to prefer it. And today, UPI is part of daily life in India. More than 600 banks are connected to the system, and there are more than 200 apps that also run on it. And every single month, more than 18 billion transactions take place on this platform. That, by no scale of imagination, is a small feat. A country that once ran mostly on cash has now built one of the most sophisticated digital payments networks in the entire world. But that said, there is one design choice that the IMF believes truly sets UPI apart, and it's not the simplicity or the scale or even the speed for that matter. It's the fact that the system is interoperable. That's what makes it world-class. And to understand why interoperability matters in the first place, you can think about how many other apps work. Let's take Uber as an example. See, if you are on the Uber app, you can only book Uber rides. You can't really use it for calling an Ola or a Rapido for that matter. So basically, everything which includes you, the driver, and the app has to be a part of the exact same system. That's what's called a closed loop model. And most of the digital payment systems around the world still work in this way. If both you and the shopkeeper use the exact same app, the payment goes through. But if you're not using the same app, you're out of luck. You either download a new app or you go back to using cash. Now, interoperability breaks exactly that loop. It allows anybody to use any app to pay anyone else, no matter what app they are using. It's a bit like email. You can have a Gmail account and you can still send messages to someone who's using Outlook or Yahoo or some other ID for that matter. That is the kind of open and flexible system that UPI was built to be. Now, of course, making such a system work is not at all easy. The IMF breaks this down into three important layers. The first one is the technical layer. See, all apps and banks need to speak the same language. In UPI's case, everyone talks to each other using the same NPCI protocol, which is what ensures that money can be smoothly moved between them. Second is the semantic layer. See, even if the wiring works, you need to make sure that everyone interprets the signals in the same way. So if one app says transfer 100 rupees or insufficient funds for that matter, every other system also needs to understand what that means in the exact same manner. Now on UPI, every response code and message format is standardized, which makes this possible. And the third one is the business layer itself. Everyone, right from the biggest banks to the smallest fintech players, has to agree on who pays for what and how disputes are resolved here, and also how responsibilities are shared. Once again, NPCI played the role of a referee of sorts here, where they enforced common rules across the entire board. Now, this clarity across all of these three layers is what allows the system to work so very smoothly. And that smoothness gives rise to some very, very important benefits. The most important and obvious one is that the users have a real choice. In the early days of UPI, most people just use their bank's own UPI app. But over time, they have moved to other apps like, let's say, PhonePe and Google Pay. And switching was easy because your money did not really depend on that app specifically. So if one app was buggy or unreliable, you could simply shift to another one where it was better. In fact, the IMF actually found out that if an app had 1% fewer failed transactions, it saw 4% more users the very next quarter. That's how sensitive people were to quality and how easy it was for them to vote with their fingers, so to speak. Now, this competition also made the system a lot more stronger. Since no app could take users for granted whatsoever, they were forced to improve and become the best version of themselves. The best apps saw their failure rates drop significantly significantly over time, even as usage started to grow. And despite that, new players could still enter the market by offering something better or different. PhonePe, for example, started by focusing on everyday users, BharatPay focused on merchants, and some apps added features like sound boxes which told shopkeepers aloud when a payment had gone through. Basically, the open nature of UPI allowed for all of these innovations and things to happen. And there's data to prove how powerful this shift was as well. The IMF paper looks at one digital wallet app, which they don't name, but it most likely is Paytm, which was originally a closed loop system. But when it switched to UPI and became interoperable, the impact was absolutely massive. In districts where this app was popular, digital payments went up by 8 rupees per person per month just because people now had the freedom to use it a little more broadly. And that very act of making something open led to more people using it. But again, while UPI has succeeded because of its openness, the story does not end here at all. There is now a new risk emerging, which is that this interoperability could slowly start to fade. Today, just two apps, which is Google Pay and PhonePe, account for more than 85% of all UPI transactions. About half of all payments happen between people using the same app. And that means users are starting to now cluster. And that clustering, if left unchecked, could lead to the same closed loop problems that UPI originally set out to avoid. Now, the IMF raises a very quiet warning over here. What if one of these large players start offering app-specific features that only work if you and your friend both use the exact same app? And what if they start bundling things like loans or insurance, or they start pushing users towards just using their own QR codes? In fact, the RBI actually had to step in early on and stop companies from issuing their own QR codes because it would have undermined the idea of one unified system. But that battle is very much ongoing still, because as good as UPI is today, it only works as long as everyone sticks to the rules of being open and interoperable. And the moment somebody tries to build their own walled garden here, the cracks will begin to show, and that might get a little problematic. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, we reported earlier how Ola Electric saw a shocking reversal in the fourth quarter of FY 2025, with revenues crashing 62% and losses ballooning. Now, the first quarter of FY 2026 results are out, and while losses are still high, there is a faint hope of operational improvement. The company posted a net loss of 428 crore rupees, which is higher than the 347 crore rupee loss in the first quarter this year, but it is an improvement over the 870 crore rupee loss in the fourth quarter. Revenues as well are up sequentially to 828 crore rupees, though it's still down nearly 50% year over year. Second, earlier last week, Jane Street was banned for allegedly manipulating expiry day index options, but now there is an interesting update to it. The US-based firm deposited 4,843.5 crore rupees into an escrow account on 11 July, fulfilling SEBI's conditions to lift the ban. Trading can now resume, but with a caveat, which is the flagged strategy remains off limits. Third one, Blinkit is now shifting to an inventory-led model starting 1st September 2025, where it will directly purchase products from sellers instead of merely storing them. This move is aimed at streamlining operations and complying with Indian regulations on foreign ownership in online marketplaces. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.